This is my insurance renewal letter, and this is last year's. Same cat, same car, same apartment. 0 claims. One of these numbers is 24% bigger. I did not crash into anything. And this isn't just my letter. At its worst, the price of car insurance in America rose 20% in a single year, while regular inflation was cooling off. So whatever happened to this number did not happen in my driveway. Someone, somewhere, crashed into something. Someone's roof met some hail. And there is a spreadsheet connecting all of us. By the end of this video, you'll be able to read this letter the way the company does. Which parts are real risk, which parts are lag, and which part is a quiet bet on you not leaving. The easy story is that you filed nothing, so the higher number must be a shakedown. Half a story. The other half? They lost money on you first, then overcorrected. Insurers keep a scorecard called the combined ratio, claims plus costs per dollar of premium taken in. 2020, personal auto, 92.5. Empty pandemic roads, nobody crashing. They made money while the cars sat in the driveway. 2022, personal auto hit 112.2, confirmed by AM Best. For every premium dollar in, about $1.12 went out. Home was worse. 2023 homeowners ran 110.9, the industry's worst year since 2011. Nobody was near insolvency. Bond portfolios cushioned the losses. By 2024, the machine was profitable again. Property casualty overall at 96.4, a recovery regulators said was led by personal lines. And the overshoot receipt? By May 2026, car insurance prices were down 2% year over year, Bureau of Labor Statistics, while regular inflation was still positive. This started as catch-up. Then the catch-up overshot. Not gouging, not charity. A pricing machine with a throttle problem. Your premium isn't a bill for what you did. It's a forecast of your pool's future losses, plus the cost of the capital standing behind the promise to pay. Your spotless record is one input in that forecast, not the input. Look at who shares your pool. Your neighbor whose roof met a hailstorm. One bad storm season. Insured catastrophe losses have run $80 to $120 billion a year globally in recent years, most of it in the United States, per Munich Re and Swiss Re. A courtroom you've never seen. Before its reforms, Florida generated about 71% of America's homeowners insurance lawsuits, while producing about 15% of its claims. The industry estimates that litigation beyond ordinary inflation added over $230 billion to liability losses in a decade. That figure is the industry's own, and consumer advocates dispute how much is abuse versus legitimate claims. None of these people know you. Every one of them is in your number. Under the pool, 3 engines pushed costs up at once. 1. Rebuilding. Reconstruction cost, materials plus labor, rose 63.7% in the decade to late 2024, per Verisk. Your policy covers what it costs to rebuild, not what Zillow says it would sell for. And the estimate drifts. Left unrecalculated, a home's rebuild figure runs about 4% low after 3 years, 11% after 5. Quiet underinsurance, accruing while nothing happens. 2. Cars became computers. Used car prices jumped 37% in 2021 alone, Bureau of Labor Statistics, and a totaled cars check is priced off that market. The parts got smart too. A bumper is a computer. A cracked windshield can mean recalibrating a lane camera. Injuries got pricier as well. Bodily injury claims cost roughly a third more than in 2020. 3. The insurance behind the insurance. Insurers buy their own coverage, reinsurance, to survive the worst years. At the January 2023 renewals, U.S. property catastrophe reinsurance jumped 31.3%, Guy Carpenter's index, the hardest market since the mid-2000s. That cost cascades into your premium with a lag, worst in catastrophe states. But watch the tide. By the January 2026 renewals, that same index had fallen about 12%. The wholesale price already turned. Your premium hears about it later. If the losses were 2022, why did bills keep climbing into 2025? Rates are filed and approved one state at a time. Some states make an insurer ask permission first. Others let it charge while the regulator reviews. Either way, the calendar slips. 2022's losses landed on 2024's and 2025's renewals. California held rates below what the math said they cost. Insurers didn't cut prices, they stopped writing. Major carriers paused new home policies. The insurer of last resort, the FAIR Plan, hit 555,000 policies by March 2025, up about 100,000 in 6 months. In 2025, it relented. Catastrophe models and reinsurance costs may now enter rate filings. Florida went the other way, the courts. Its state-backed insurer, Citizens, grew past 1.4 million policies by late 2023, the largest in the state. Then, a December 2022 reform ended one-way attorney fees. Insurer defense costs fell roughly 2/3, a ratio of 8.4 down to 3.1. Citizens shrank to about 778,000 by mid-2025, and some insurers filed rate reductions. A Senate committee's county-level data, 249 million policies, shows non-renewals rising fastest where premiums rose fastest: Florida, California, Louisiana. Households losing coverage, not line items on a chart. Cap the price and you don't get cheap insurance. You get less insurance. Everything so far at least pretended to be about risk. Now the dial that isn't. In most states, your credit score moves your car insurance price. Same record, credit alone. The Consumer Federation of America compared identical records. Poor versus excellent credit ran 172% more in Minnesota, 263% more in Michigan. 3 states ban it for auto pricing: California, Massachusetts, Hawaii. Washington's regulator tried, the courts overturned it. There's also a file on you. Clue, run by LexisNexis. 7 years of your auto and property claims read on every quote. Then a dial unrelated to risk. Some models estimate not how likely you are to crash, but how big an increase you'll absorb before you shop. Call it the second dial. Its label, Will They Shop? The regulator's own body, the NAIC, called pricing on willingness to pay rather than risk unfairly discriminatory back in 2015. Roughly 18 jurisdictions told insurers to stop. Detection is the hard part. Insurers answer that every rating variable is filed. Britain measured it. The financial regulator found 6 million customers overpaying by £1.2 billion in a single year, some more than 50% above the price for their risk. They named it price walking. On January 1st, 2022, they banned it. Your renewal quote may not exceed a new customer's for the same risk. Projected saving, £4.2 billion over 10 years. America has the same suspicion on paper and no measurement. No US regulator has put a number on it. Somewhere along the way, the loyalty discount became a loyalty penalty. So, for us cats, the dial bets you won't move. Here's what moving looks like. Shop at renewal. The model assumes you won't. At the peak, about half of American drivers said they were shopping, per J.D. Power in 2024, record highs. Said, only about 4% actually switch in a quarter. Of those who did, 92% saved money, and 63% saved at least $100 a year, per LendingTree, March 2025. The dial reads both ways. It can also read, will leave. The claims math. One at-fault accident raises the average full coverage premium about 43%, roughly $3,300 a year against $2,300 clean, per bank rate. And the surcharge follows you 3 to 5 years. So a claim barely above your deductible can mean paying for the privilege of raising your own rate. Depends on your cushion. A garden hose dent is not a hospital bill. Know your file. You can pull your Clue report free once every 12 months, federal law. And check your dwelling coverage against what it costs to rebuild, not what the house would sell for. The forecast? Car insurance to flatten, in places fall as competition returns. Home insurance to keep rising, more slowly. The pool is calming down. The bet on your inertia isn't going anywhere. Back to the letter then. Same cat, same car. But it reads differently now. Itemized. A line for the pool, a line for lumber, a line for the radar hiding in a bumper, a line for the insurance my insurer buys, a line for 2 years of losses still washing through a regulator's inbox. And at the bottom, in very small print, you, probably not leaving. That last line is the only one you write. The pool is real, the hail was real, even the ketchup was real, until it wasn't. For us cats, the rule holds. A premium is a forecast, not a verdict. And a forecast can be argued with. Once a year, in writing, with 2 competing quotes on the table. This cat has an appointment.